What's going on, everybody? Welcome to the Loan Lads, presented by Park Place Finance. We're your go-to real estate podcast for real estate investors, entrepreneurs, and builders nationwide.
That's right. Whether you're flipping your first house, breaking ground on a ground-up construction, or building your rental portfolio, we're here to break down the lending side of the business.
The Loan Lads is brought to you by Park Place Finance, a nationwide hard money lender specializing in fix and flips, ground-up construction, and DSCR rental loans. Learn more at parkplacefinance.com.
Let's get into it. Let's get into the pod.
All right, y'all. My name's Donovan. I'm the Chief Revenue Officer here at Park Place Finance. I've been in the industry for about 4 years now. Graduated from Texas A&M roughly four and a half years ago, and kind of jumped right into the industry on the real estate side of things as soon as I graduated.
My name's Joe Morley. I've been in the real estate industry a little less time than Connor. I've been in the real estate industry for around 3.5 years. To be honest, I kind of fell on my feet in the real estate industry. Never been in lending, didn't actually study real estate. But found myself in the position through a teammate of mine that was doing an internship at the time, and interviewed, and then really just fell in love with the industry as soon as I got into it. The fact that every day is a little bit different in the hard money space really enticed me, and I'm super competitive after playing college sport as well. The real estate industry is super competitive as well, which drew me closer into using this as a form of a career. And now 3.5 years in, I'm one of the team leads at Park Place Finance. So I run a team of around 7 of the sales guys, and help towards the bigger goal of Park Place to build and become one of the biggest hard money lenders in the country. Yeah.
Do you want to touch a little bit on the piece you just said about how it's different experience every day?
Yeah, for sure. So, I mean, every day you're seeing different scenarios, right? One day you may see 6 ground-up constructions, but those 6 ground-ups are in different states. They're building different properties. They're different investors. They have different experience levels. So every single deal that's coming across your desk is a complete different scenario that you as the lender have to put all the pieces together to make sure that deal works, and that borrower is, number one, getting into a good property and is actually going to be profitable on the backside to perform his exit strategy, whether that be refinance or sell it for a profit. And then number two, we've got to make sure the interested Park Place as well are being looked at. So is this borrower going to be a good borrower that's going to be able to pay on time? Is this borrower going to be able to get through the project in time and continue to build without any stop-starts? Are we going to form a long-term relationship with this borrower as well? So the fact that every day is different is super enticing to me, and this is why I kind of stay around in the industry.
Yeah, one of the things Joe just touched on is kind of why I got in the industry, is being able to help real estate investors nationwide, but also being kind of the backbone of the deal, being able to look at the numbers and make sure that it's actually profitable, make sure the client's going to make money and be successful at the end of the project. So whether that's just having an open, honest conversation that maybe the deal isn't profitable, or maybe they're not going to make money on the monthly rent, it's not going to cover the debt to income, whatever that may be, being able to have those open and honest conversations and help a client find the right deal is, I think, what enticed me to get into this industry.
For sure.
We're in Austin, Texas, and one of you has an accent.
Yeah, so the Loan Lads is really because Joe's European, and when he came in, he said lad all the time, so that's what we started calling each other, lad.
As you can tell, I'm from Dallas, Texas. I'm from the northeast of England, close to Newcastle. And where the Loan Lads came from is, as soon as I started work, I call all the guys in the office, lads, what's up, lad? How we doing, lad? And when I first came in, the team name was the Cash Cowboys. We're in Austin, Texas, so it makes sense. And then when I took over the team, probably 2 years ago, I wanted to make it my own, so I called it the Loan Lads.
The Loan Lads.
And then now we just stuck with the name, and we're going with the Loan Lads for the pod. And as you guys know, we said hard money a couple of times already. Let's kind of deep dive into the word hard money, what hard money means. I know there's a lot of preconceived ideas of what that is. So for you guys out there that don't really know what hard money is, I mean, Connor, talk to us a little bit about what our industry does and any preconceived ideas of what hard money is.
Yeah, so hard money is it's a term that a lot of people use in our industry, but a lot of outsiders don't necessarily know what exactly that means. You'll always hear, what is hard money? Hard money lending is basically where, instead of traditional financing where they're qualifying you solely on your debt to income, looking at what you're making yearly or monthly versus how much debt you've actually consumed. Hard money is really asset based, right? So we're looking at the hard asset itself, which would be the property. We want to make sure that the property makes sense. So long as the property makes sense, we're really just looking at the borrower, making sure that they have enough liquidity to bring the cash to close, or cover interest reserves and the rehab contingency. That's really the main difference. Is it's more hard asset based, meaning the property focus versus the actual debt to income of the individual borrowing the money themselves.
Yeah, absolutely. And you were in sales for the longest time, and that's how you got your break in the hard money space. I'm sure that day in, day out, you get clients on the phone really asking, what is the benefit of hard money? What is the benefit of using hard money over your standard bank conventional financing? And I think the biggest thing is, number one, the speed of close.
Yep.
Typically, for conventional loans, it takes around
60 days or so, sometimes 90.
Yeah.
It just depends on the bank.
Yeah, to be able to actually go from soup to nuts and get a deal financed. Like Connor said as well, they're looking at your debt to income. So that's really based on your income as an individual. And that's usually W-2 income, right? Or you've been a 1099 employee for a couple of years and you're able to show that income there as well. Now, hard money is different in that aspect because we can close a deal from soup to nuts in around 3 to 5 days.
Yep.
Compared to the 60-day close, which for a investor that does this on a day-to-day basis, or maybe a new investor, especially for the new investor to be competitive in their offers to actually get these good deals under contract. Speed of close is one of the biggest things that.
Yeah, I think that's a huge point as why an investor would use a hard money lender specifically, or even a private lender. In that case, is the speed to close. So there's a lot of other things that I think are enticing for real estate investors to use hard money for. I think one is the kind of flexibility and edge cutting, ability to make a deal work. Whereas we can look at a deal, structure it, and understand the profitability side of things in a matter of minutes. But also, for an investor to qualify with a traditional bank, there's a lot of documents that come into play.
Yeah.
And we could touch on those, whether it's collecting W-2s, collecting all of your past 3 income statements or monthly income statements, pay stubs, whatever that may be. On our side, really all we're collecting on the borrower is the bank statements, just verifying that they have enough liquidity to actually close the deal. So the kind of, we consider it light doc, right? Like light documentation to be able to collect before closing. Whereas a traditional bank, there's a lot more paperwork that goes into it, which is part of the reason why we can actually speed things up.
Yeah, for sure. And touching on that as well, in terms of the documentation that's needed, not only does all that documentation need to fit a box for your conventional financing, it's pretty cut and dry. For hard money, Connor mentioned it a little bit earlier, it's definitely much more flexible in terms of what we can do, what documents we can allow. Not to say that we're going to overlook certain areas and cut corners, but the flexibility in what we look for on a deal, it really gives clients better opportunity to go pick up deals that are maybe not your cookie cutter, but also these deals that are not cookie cutter. I've seen it time and time again where some of those are the best deals and the clients walk away with the biggest profits and, do something good in the real estate game. So.
Yeah. All right, Joe, so let's touch on a couple of the common misconceptions here in the hard money industry.
Sure.
First one I want to touch on is hard money lending being too expensive.
Yeah, for sure. First of all, we're not going to sugarcoat it. Hard money typically is more expensive than your conventional financing. But it kind of goes back to the points that we made in terms of more flexible, light dock, asset base, don't have to qualify, debt to income, more flexible in terms of the deal. We're looking at different things. All those items put together, I believe, in my personal opinion, as a real estate investor, those are the key items that actually help you get those properties under contract, help you close quickly, and help you pick up the deals that you actually want to pick up as an investor. But also, on top of that, these are short-term loans, right?
Yep.
These are bridge loans that are getting you from point A to point B. It's not the be-all, end-all loan that you should be in, like your 30-year conventional loans. That's not the purpose of these loans. It's to help you either purchase a property, pull cash out of a property that's sitting on the market that you've just maybe built or completed the rehab financing on. It's there to help you do a quick fix and flip that you may be in for 6 to 12 months. So yes, even though the interest rates on these may be higher, any investor that is savvy and actually has a deal that they believe in, the difference between your conventional 6% or around that number to ours, 9 to 12% in interest, the difference between that over a short period of time, especially with all our loans being interest only, is not going to hurt your deal. Yep. Number one. And number two, it's actually going to help you win your deal using hard money compared to your conventional financing. So.
Yeah, I think one thing you touched on is the timeline of the loan, right? So most of these loans are 12 to 24 months. So you're not keeping this interest rate of anywhere from 9 to 12% for 30 years, right? And interest only. You're supposed to be in and out, hopefully in 3 to 6 months. Sometimes it might take 9 to 12. But that's why these loans are short term. It's meant to get in and get out as soon as possible, whether you're selling or whether you're going to refinance into that long-term 30-year fixed, where the interest rates are lower, right? Anywhere from 5.99 to 8%, depending on where the market stands currently.
Yeah, and then typically I want to touch on points of origination, right? Yeah. So in your conventional space, you'll typically see, I think right now it's like 2.65% that the lender charges?
Yeah, on average. It really depends. Points on the conventional side are really based on the interest rate at hand, right? So you can go with a standard rate, par rate, where you don't have to pay any points, but you can also buy down that rate. So there is flexibility on having, a 0-point option on conventional versus a higher point option, and that's all, rate based. Whereas on our end, we typically have set origination fees because the interest rates are kind of set in stone based on experience and credit, right? So, for example, on our end, depending on your experience level or your interest rate given, and maybe the property itself, right, the risk factor of the deal, those points typically range anywhere from 1 to 2% on our end, and that's kind of a flat fee.
For a lot of new people that are tuning in, new investors that are trying to get into the game, the term hard money, I mean, when I first got into the industry, it kind of sounds like you're a loan shark, right?
Yeah.
That's definitely not what we are. We are... this industry's grown even since the time that I've been in it, for a little over 3 years now, and the professionals that I've been able to actually meet in this industry, and the knowledge that I've been able to gain, that's one of the biggest things that I've taken away from starting my career in the industry, my conceived idea of hard money was definitely wiped out probably a week in, actually being in the office, talking to these people that are doing these investments. It's a professional business, and it's how people put food on the table at the end of the day. And it's awesome to be a tool in their toolkit to be able to actually go and finance these properties.
A common misconception in the hard money industry is that it's really designed for real estate pros, right? Somebody who has an extensive background with investing in real estate. And that's kind of what the misconception I had when I was coming into the industry was, but that's not actually the case. One thing that we've seen is there are lenders out there who really only want to finance properties for somebody who would be considered a seasoned pro in the real estate game. But there are a lot of lenders out there who don't look at it that way. They want to get in with a first-time investor who has the funds to bring in for a deal and help them grow. And I think that's one thing that I love about Park Place is I'm all about helping people. And I think being able to find a first-time investor who wants to get into the game, whether they're an entrepreneur or maybe have a full-time job and this is their side hustle, is being able to come into into a property and, once they locate something they like, being able to run the numbers with them and talk them through how this deal is profitable and what kind of return they're going to see on their investment at the end of it, whether it's a flip or, maybe a rental property they're going to rent out month over month. Us, at Park Place Finance, we do lend to first-time investors. So for us, being able to kind of see an investor start with their first project and then help them grow throughout their investing careers, I think one of the biggest joys I've had working here.
Yeah, and to bounce off that, I mean, some of our best clients have been guys that have been first-time investors, and I always remember those calls.
Yep.
Those calls with the first-time investor, the wanting to get into the game. That's what gets me excited, to be honest, because I know I'm really helping someone make the next step into real estate, which is one of the best industries out there. So, those conversations with first-time borrowers are welcome pretty much all the time. It's also good as well because we can actually help teach and give our expertise on deals, looking at comps, making sure they're getting into the right deal, and so on. And those are the long-lasting relationships that from both ends is key. Without repeat clients, I don't have a business, right? Yeah. On the flip side, without lenders like ourselves, they don't have a business. So I think the biggest thing there is a partnership. And that's it's not a one-way streak, it's a two-way streak because, that's how we put food on the table, that's how they put food on the table. Yeah,
absolutely. Couldn't agree more with that. I want everybody to think of hard money like a power tool. Not every tool is the right fit for every job, but when you need speed, flexibility, and leverage, nothing beats it. All right, Joe, so one thing I want to touch on is let's give 3 quick tips for a new investor on, what they should be looking at whenever they're looking for a new investment property.
Yeah, for sure. First of all, don't kid yourself. Don't paint a picture that you've got the best deal in the century, because it's probably not the best deal in the century, but it can still be a good deal, right? So I would say don't fudge your numbers. Be honest with your numbers. Definitely be conservative. That's how I run all my numbers. If I'm still making a good deal and I'm being conservative, then that's the deal that I'm going to go towards. Yeah. So the key things is you want to look at your ARV. So checking the comps that actually comp your subject outright. Don't just go on a quick Zillow search and see, all right, I think my ARV is going to be 500,000. Let me put in 500,000 in Zillow. Yeah, I've got 10 properties that are sold in the past 48 months, right? Actually get granular with that. So whittle it down to the last 12 months. You want similar square footage. You want similar upgrades. That can all be done using the Zillow tool. We're not sponsored by Zillow, but maybe we will be at some point. Be conservative. If you got a good deal conservative, then you're good.
Yeah. One thing I want to touch on too, the ARV piece for those of y'all watching. ARV in our industry means after repair value. So that's what the property be worth once the renovations are completed. Yep. So that's kind of what your end goal is, right? Whether you're selling it or refinancing it based on that value. Yep. One other one I want to touch on is finding the right deal, right? So not only running your numbers correctly, but finding a deal in a market that makes sense. So you don't want to go to a market where, it would be considered rural, or maybe a market that is declining, right? So there's a lot of houses sitting on the market and nothing really selling. You want to go to the markets that are typically suburban or urban, have, low days on market. That's a huge key piece you want to look at. You don't want property sitting on the market for 120 days plus, consistently, right? You want to have some houses in there that are quickly selling, within 2, 3, 4 weeks, even 60 days is a good number. And the last thing I wanted to touch on too is building a strong relationship with your lender. And I know you know a lot about that, so I kind of want you to touch on it.
Yeah, for sure. We see it time and time again. I mean, I'm on the front lines in the trenches. I'm still making calls 3 years in, trying to pick up new business, just to, try and teach the guys on the team as well that is really what it takes to become one of the top lenders and top loan officers, should I say. But you see it time and time again where you'll have an experienced client and they are actually switching lenders, and we don't have a relationship with that new investor, right? They're an experienced investor, but they're new to Park Place Finance. As a lender, we want to build a relationship with you as a client, right? Yep. And in doing so, there's benefits to that. So we at Park Place Finance, we really have a tier structure in terms of your experience. So the more experience that you have, especially if you've done those flips with us, you have a track record of making payments on time, completing projects, we can see your experience. Us as a lender are going to be way more flexible with you on your new deal that you're bringing up. It's going to be much easier to close, right? The underwriter that underwrote your first deal, they've underwrote 3 or 4 deals since then. They know you as a borrower. They know what they're looking for. And usually those will pass through underwriting much quicker than someone that is a first-time in-house borrower. And when I say in-house, just the first time you've actually used us as a lender.
Right.
Not to say that that's still not quick, because that 3 to 5 day close is, pretty standard there. But just in every aspect of getting a pre-approval letter, getting to... having that relationship. So me as a loan officer, I'm more likely to take texts and calls from my repeat clients quicker than maybe some new clients that I actually don't know who phone number this is, right?
Yeah.
Additionally, as well as an investor, you want a lender that you can rely upon. To when you may be out on the field and you see a property, hey, can I get a pre-approval letter? Can you run some quick numbers on this?
Yeah.
That's where that relationship really plays into effect, and that's really what we're looking for. I mean, you've had a bunch of repeat clients, so I'd like you to talk on it as well.
Yeah. So like what Joe just said, I've had a lot of clients call me at 7 o'clock at night, and they're on site at a property, right? And they're like, hey, I need a pre-approval on this. There's already multiple offers on the property, but I want this thing. Let's run some numbers. Let's check the ARV. Let's make sure it makes sense, and let's get a pre-approval in the next 30 minutes. So those types of clients, like we're willing to jump and kind of drop everything to do that for them, right? At the end of the day, that's the relationship I've built with them, and that's the trust they've kind of instilled in me. And vice versa, right? So I'll drop whatever I'm doing, no matter time or day, and I will go and run numbers and be conservative and make sure that those numbers work for the client. Mm-hmm. And then secondly is get them pre-approval, so they're able to lock down that property and get it under contract so that we can move forward. One thing I wanted to touch on too is first timers. Tend to always shop around with a lot of lenders, and that's great, right? I always encourage people to shop around to find that lender that they want to use. Not every lender is a good fit, right? Could be personality, could be terms, could be type of products that they offer that maybe don't fit your exact investing strategy, right? So even for first timers, I'm always pushing them to get multiple quotes from multiple lenders. But at the end of the day, you always want to have that transparent conversation. So for me and some of the best clients that we've come across, they're first timers. They come in and you're able to have that honest, open conversation about what the end game is, right? What is their goal coming into real estate investing? And being able to kind of tailor the loan products that we have to them directly. So while the terms might not be the best terms day one on their first deal ever, that doesn't mean that by deal 2, 3, 4, or 5, we're not giving them very, very competitive terms, right? That might be high leverage, very low rates, low fees, or everything across the board, right?
Yeah.
The biggest thing with these first timers too is when a lender builds that relationship at the start and they kind of take it and run throughout their investing career, those are the borrowers you always see lenders giving very aggressive terms. Whether it's us or another lender, I'll come across a borrower that's maybe done 5 projects with another lender, and they'll come to us and be like, can you beat these terms? I'm like, you should take those terms and run, right?
Yeah,
they're phenomenal.
Do it time and time again. On that same exact topic there, you get someone that comes in that's been with a lender, and that we're going back, they've been with a lender for a while and they've got great terms, right? Sometimes the grass isn't always greener. It's really where you water the grass, right? And makes it grow. And that's how I see lending, and in every form of relationship that I have in my personal life as well. So, the grass isn't always greener. Yes, they may be throwing out better terms on whatever they're putting out there, right? That doesn't mean that's the best fit for you. The best fit, there's 100 different things within a loan that can really make or break a loan. And points and rate, that's not the 2 things that are in a loan. There is multiple other things, and having the relationship with a good lender like ourselves. That's really the biggest thing. Okay, so that wraps up episode 1 of the Loan Lads podcast. Thanks for joining us. I hope to see you all as we kick off our journey talking about real estate.
Just bouncing off Joe here, if you're a real estate investor looking for a fix and flip, or you're a builder, or you're even building your rental portfolio, don't forget to check out parkplacefinance.com. Please be on the lookout for our socials so you can catch clips of these episodes, and don't forget to subscribe.
So that wraps up episode 1 of the Loan Lads podcast. I appreciate you guys listening in. There's a lot more to come, and we're very excited to see you guys come along with us on our journey.